And good afternoon, financial professionals. Welcome once again to the BREW E4's program that seeks to expand your knowledge and expertise while building relationships every week. I'm your host, John Florence, standing in for Abby Fletcher, who is, again, this week still continuing her well-deserved vacation. We'll see Abby back in this seat very soon. We'll begin today by celebrating a few special days. Today is International Day for Failure, which reminds us that failure is not something to be afraid of or ashamed of, but rather embraced. The great author J.M. Barrie reminds us that we are all failures, or at least the very best of us are. And we're also reminded of the words of John F. Kennedy, who said, "Only those who dare to fail greatly can ever achieve greatly." So go out and fail at something today. You'll thank me tomorrow. Today is also International Disaster Reduction Day. So as you go about creating your next failure, please make sure that it doesn't become a disaster. We could all use with fewer disasters. And lastly, today is also National Fossil Day, in recognition of which I am your host. We encourage you to show some appreciation to these incredible time capsules, as well as the paleontologists that excavate them. Find the fossil nearest to you and be sure to thank them for their contributions. On today's BREW, we're welcoming John Rafferty. John is the founder of Rafferty Annuity Framing, which is a consulting group that helps to identify and articulate scalable opportunities where annuities can improve client outcomes. You can visit John's site and learn more about his work at raffertyannuityframing.com. John has spent the last 35 years of his career working to develop sales and marketing annuity messages for some of the biggest and most important insurance industry's names, including Symetra, AIG, and Mass Mutual. I've had the privilege of knowing and working with John since 2019, and I've been inspired by his insightful analysis and unique way of positioning today's annuity benefits. John is going to share a couple of concepts that I think are really germane to the market environment that we're experiencing today. So we'll be with him in just a moment. Before I hand over the mic, we do welcome your questions and comments on the BREW, but we ask that you please enter them into the chat box on your screen, and we'll address them after John's presentation. And be sure to stay on the call for the weekly drawing, where we will select an audience member to receive a small token of our appreciation for their attendance. John, we welcome you to the BREW, and the floor is yours.
Hey, thank you very much, John Florence, and thank you, Danielle. Great to be with you folks at E4 Insurance Services. John, I don't know if you were trying to play head games with me with your international failure and disaster days, but I'll do my best to make sure my brief 12 to 15 minutes is neither. But again, want to thank you all for your time today. Just want to run through, as John said, a couple quick ideas. Before I get to those, I have spent my whole career in the annuity business, and most recently, probably more in the fixed and fixed index side of things. But when I think about the risk mitigation properties of really all annuities, I think about a famous quote from Peter Lynch, the old Fidelity Magellan manager, who scored a tremendous record from 1977 to 1990. I just read this yesterday, but I thought it was worth sharing. And what he said was this, and this is kind of germane to what's going on in the markets today with them going back and forth. He said, "More money has been lost by people trying to anticipate and protect themselves from bear markets or corrections than has actually been lost in those bears or corrections themselves." And as I thought about that, I thought about the beauty of the products that we all embrace, which really are meant to imbue folks with the confidence to remain in the market, because what we have, whether it's fixed annuities, fixed indexed annuities, annuities with living benefits, those are really meant to imbue clients with the confidence to stay the course. It takes a little bit of the pressure off the rest of the portfolio. So without further ado, I'll go through a couple quick ideas. First idea I like to call the fixed income alternative, FIA. Yes, that's a play on words. I'm 57 years old. I don't mind sharing that with you. So like John Florence, I guess I'm a budding fossil. But on September 30th of 1981, almost exactly 40 years ago, was the birth date of the bull market in fixed income. Yours truly was a senior in high school, probably suffering through my SATs, didn't know what fixed income meant, certainly didn't have any idea what a bond fund was. But that was the day the 10-year Treasury peaked. at 15.82%. The problem was, as you remember, the Federal Reserve governor at the time was a guy named Paul Volcker, and he was really trying to tamp down inflation. The way he did that, obviously, was cranking up that short-term federal funds rate. So you had short-term rates that were higher than long-term rates, and that's why nobody wanted to buy the 10-year Treasury or long paper. They were convinced that bond values would keep dropping and that short rates would keep going up. So they didn't want to commit to long-term, 10-year Treasury bonds when they could have locked in almost 16%. Unbelievable. People really can't see, obviously, the future, nor can they really anticipate what's going to happen. Nobody anticipated a 40-year secular trend of declining rates all the way down to almost zero last year. What that means is, for most of your clients who I'd say are under age 80 or 90, they don't know anything but a bull market in fixed income. If you think about it, most people, again, I don't mind telling you, I'm 57. I've never owned a bond or a bond fund. I feel comfortable being in equities. There are probably other clients like that you're aware of. But I would have to say there's probably no client out there today who knows anything but a bull market in fixed income, if they have been in fixed income. And because of that, it's going to be quite an adjustment to think of what's a different way to create some portfolio ballast other than what I've been taught is the way to do it, whether it's a 60-40 or what have you. And as further evidence of sort of the dangers ahead for fixed income, you've got the iShares AGG, which is probably the best known proxy for fixed income in total, because that includes government issues as well as corporates. That's currently yielding about 1.8%. It's got a duration of about 6.5 years. The LQD, which is the iShares investment grade corporate bond ETF, yields a little bit more, obviously a little more spread because there's no government in here. It's about 50 basis points higher, 2.3. That's got a duration of almost 10 years. So you can see if we just get a 1% rise in the general direction of rates from here, which to me seems very possible, right? We've gone from 1.2, 1.3 all the way to 1.6 very quickly. A lot of prognosticators out there easily can see us going above 2 in fairly short order. People are going to lose money in these funds. In fact, the AGG over the last year's lost 3%. The LQD's lost 2%. That doesn't happen a lot in fixed income world, but it just happened. So going forward, what might be a solution for ballast in a portfolio? And I think you could pick something like an FIA, a fixed income alternative, other known as a fixed indexed annuity. And I know at E4 Insurance Services, you've got some great FIAs out there with caps on the S&P anywhere from, call it 4.5% to 5% for some of the most competitive rates. And I could tell you, as John was so kind and sort of puffing me up a little bit, I've done a lot of analysis on FIA historical returns over time. And what I've concluded, along with other colleagues I've worked with in those fine companies John mentioned, is on average, you ought to expect over the course of a 5, 7, or 10-year FIA holding period with an S&P index, you ought to expect you're going to probably, or your client will experience about a 60 to 70% of that cap over the holding period. So that means if you got a 5% cap, over let's say a 7-year surrender charge period, it's probably reasonable to assume that the client could earn on average about 3 to 3.5% per year on a compound annualized growth basis. That's pretty good compared to what we've been talking about with traditional sources of fixed income. Because again, if rates keep rising, there is not a lot of cushion in the yield to absorb the capital loss from those rising rates. And again, I think that's where FIAs can maybe not completely replace fixed income. I wouldn't lack the hubris to say that I know that fixed income is going to fail going forward. I think it's going to be challenged, however. And I think FIAs can be a great way to, again, create some ballast in a portfolio. Now, some of you might be asking, yeah, John, but listen, an S&P cap is great, but the S&P, isn't that trading near all-time highs right now? And the answer is it is. Particularly if you look at something like the Shiller CAPE, the cyclically adjusted price earnings ratio, right now it's almost 38. That is very close to its all-time high. Generally speaking, the Shiller CAPE and frankly, forward PEs are pretty good prognosticators of forward returns in the stock market. The difference with a FIA, however, is because of that basic structure of locking in returns each year and no capital losses. If you were to look at a dot plot chart of forward returns in the S&P total return index over time, you would see it sloping to the southeast, right? As PE ratios are higher and higher, returns get lower and lower going forward. But if you were to look at a FIA with that same PE dot plot chart, you would see a fairly consistent, for a given cap, a fairly consistent expected return in the future. And again, it's because of that annual locking in of gains. You lock them up, and the fact that you can't lose any capital. In fact, if you were to look at any 5 or 10 year period in the markets, while they can be vastly disparate, I would urge you to go look at the 10-year lost decade that we had from 2001 to 2010. If you look at the number of positive years in the S&P, then it was still, I believe, 6 or 7. And again, that's the thing to keep focused on. It's the fact that you lock in those gains each year and you're not subject to cumulative damage that the S&P is. So I think a FIA, an FIA, is a great fixed income alternative going forward. Okay. That was idea 1. Let's look at idea 2. This is an idea I like to call avoiding forced sequence of returns risk. What do I mean by that? It's funny. I just got an email from my 84-year-old mother today. She lives in Connecticut. My father passed a couple of years ago, so she's finally with her advisor aggregating all of her assets. And she got her CVS/Aetna, where my dad used to work years ago at Aetna, got her CVS-Aetna 401k rolled into an IRA with Vanguard or with Schwab. And they first dispersed an RMD check to her, and she wanted me to see it. And my point is, she's lucky. She's 84. And she's got pension income. She's got all kinds of income. So she's fine. But the folks who are, say, within 5 years of age 72 could be in for a bit of an unpleasant surprise. So if you're 67, you're close to retirement or have just retired, you haven't started taking any money out of your IRAs yet. Maybe you don't feel like you have to yet to live on. Point is, at 72, the government says we want our tax revenue. And at 72, you have to take out, as you know, 3.65%. The challenge is going to be, if that age 72 corresponds with the beginning of a secular bear market, that can be a problem. That's where your forced sequence risk comes. I'll give you a quick example. My late great dad was born on June 8th, 1938. If you fast forward 70 years, he turned 70 and a half, December 8th of 2008. What was going on in the world on December 8th of 2008? We all know, right? We were in the teeth of the financial crisis. I had just moved my family from Hartford to Houston, left a perfectly good job at Mass Mutual to join AIG. I was in the firestorm. I understood all of that. Fortunately, what happened for my dad, he turned 70 and a half in December of 08. As you know, April of 09 was when he would have had to have taken his RMDs. And that was, strangely enough, so close to that, Mark Haynes low. Remember Mark Haynes from CNBC? He called the bottom of the market, which was March 9th of 2009. So my dad turned, that age where he would have had to take that RMD at the very latest by that date. Fortunately, the government decided to give folks a pass, just like they did last year for the pandemic, and my dad did not have to take that RMD. I don't suspect that's going to continue in the future if we happen to get a nasty bear market and somebody turns 72. So I said 3.65% was the amount you must take out of your IRAs and 401ks at age 72. You are able to aggregate your IRAs with respect to how you satisfy that RMD. And here's a real simple idea. Again, at E4 Insurance Services, you've got some great competitive indexed annuities with guaranteed lifetime withdrawal benefits. I've taken a look at them, and I just looked at 65 to 70 and used that as a proxy for, maybe you buy it at 67 and you start withdrawing at 72. But the point is, you can guarantee a cash flow from every dollar that you put into that FIA with a GLWB attached is going to guarantee that client the equivalent of an 8% cash flow relative to what they put into that contract. And if you do the quick math, 3.65 is 45% of 8%. What that means is you'd really only need to allocate about 45% of the client's aggregate IRA values at, say, 65, 6, 7. Let it bake for 5 years. And then when you let it bake for 5 years, they're entitled to an 8% withdrawal. Should there be a downdraft in the market at that time, the client can probably satisfy all their IRA RMD obligations from just the indexed annuity, leaving alone the rest of the portfolio that's been damaged by that drawdown and not having to have it suffer from additional withdrawals on top of, the market forcing down values. So really simple idea. Just think 5 years ahead. Look in your book at any clients who are between, call it 65 and 68, and take a look at their IRA contract values and just say, hey, this might be a great time, particularly given where market values are now, to take a little bit of the edge off and prepare for the unknown in the future. Here's the good news. If all the market prognosticators are wrong and the market continues ripping higher and 5 years from now it's doubled, the client's got optionality, right? Because that GLWB almost acts like a call option on income, right? Because it can be exercised, but it doesn't have to be. And that means the client can then instead decide to satisfy their RMDs, maybe by just taking it out of the excess returns from a portfolio. But the basic point is that GLWB serves as a great core holding to take care of business should markets go south. John, that concludes my 2 quick sales ideas. I've not been watching the clock, but I'm hoping I got it in under the wire.
You're doing great, John, and we certainly appreciate that. Those are 2 really great shares. We're going to open it up for any questions from anybody that's in the audience. In the meantime, I have a couple of questions that I would like to ask. First, on the first idea that you're mentioning, you were looking out and kind of forecasting that perhaps we're going to see some increases in the interest rate. And I just am curious of, your opinion about this. Given the amount of increased debt that the country has undertaken under the past several years, and I don't know what the total number is, but something along the lines of $8 trillion. And, if we start, and also the fact that we're seeing some statistics showing that we're moving into this inflationary environment where inflation seems to be higher now. It may be related to COVID. It may be something more systemic than that, but these countervailing pressures, if we increase rates to counterbalance the inflationary moves right now, is that going to have an impact on the economic engine that we need to be able to resolve the debt issues that we're getting into? This isn't really related to the annuity at all, but just how does the Fed balance something like that? I think
it's a great question, John, and it's one that's been asked, I think, in different ways over the last couple of years. And I think the answer is it's really the speed of that increase in rates that I think is important, right? I think everybody believes that the economy can support higher rates given all the other metrics of unemployment and GDP growth and productivity growth and all that. What it can't support in the short term is a rate rise of, say, 150 basis points in 6 months without some pretty harsh damage to the markets and perhaps even to the economy. But this is just Rafferty talking. My sense is that the rest of the world, particularly emerging markets and developed overseas markets, Europe has been sort of way below trend growth for a decade, right? For a number of reasons I won't get into, but that may be coming to an end, based on the political will of the leaders and the populace to finally get back to growth. And if that happens, whether it's there or in Japan or even China gets back to growth, the thing that really keeps our 10-year treasury depressed, as you know, is all the foreign buying. And, that foreign buying is likely to slow down if the difference between what we're crediting on our 10-year and what, folks are able to get overseas, finally compresses. Germany, I think, is still at a negative interest rate. I think a lot of the developed world has negative real rate or negative nominal rates. Everyone has negative real rates right now. But hopefully that answered your question. I think it's the speed of the rise that really has the impact. And again, I think the most important thing to understand is, the Fed doesn't control the 10-year. The Fed controls the federal funds rate, right?
Right.
I'd say the animal spirits and overseas buying, controls the rest of the federal fund. The 10-year. I guess it's controlled a little by the Fed with their quantitative easing, the 120 billion a month in buying. But I think once they slow that down, the animal spirits come back.
And at an individual client level, particularly with relation to their fixed income portfolios, and you might know some of these numbers off the top of your head, and in a rising interest rate is going to mean a corresponding decrease in the value of those fixed income portfolios. Is that correct?
That is correct. Yep.
And do you know how that works? I mean, how much does an interest rate have to rise before you start seeing the material?
Yeah. So basically, I believe the basic formula for interest sensitivity is take a given rise in rates, multiply it by the duration of that fixed income holding, and either a given rise or decline. If rates rise 1% and you've got a 9.7-year duration, the price of that holding will decline by almost 10%. Now, the thing that will cushion that decline a little bit is the current yield, right? So the LQD has a current yield of almost 2.5%. That will cushion to some degree the loss due to a rise in rates, but it won't cushion it all, right?
Yeah. And basically reallocating some portion of the fixed income portfolio to an indexed annuity can help mitigate some of those potential portfolios.
Yeah, absolutely. And I think the only caveat I would add to that is, and there's been a lot of chatter about this, particularly among some of the some of the real fixed income nerds out there, is you do get a nice core ballast holding with an indexed annuity in a portfolio. What you're not going to get is opposite correlation to equities, right? So in a healthy market long term, you should expect to see bonds go up when equities go down. That certainly hasn't happened of late. They've both lost value in the last few weeks, right? Bond values have dropped as rates have risen, while equities have also gone down. But that's why I'm saying I don't know how prudent it would be to cast fixed income aside completely. I think it still makes sense to some degree. I can't tell you what type of fixed income, whether it's high yield or floating rate or whatever. But the point is, I do think FIA deserves a consideration as a piece of the portfolio ballast.
Excellent. Thank you. Any other questions from the audience? Okay, and seeing none, John, what I would ask you to do at this point, if you don't mind, is can you pick a number between 1 and 20 for us, please?
I can, and I'm going to pick 13.
13. Lucky 13. And Chad Lindgren is our winner today. So Chad, be on the lookout in your email for a nice little gift of token appreciation from E4 for your participation today. So please join us for next week's program on the BREW, where we're going to welcome Josh Meester, one of E4's senior case designers. And Josh is going to share his 100 goals challenge with you. And having undertaken Josh's challenge, that's a tongue twister, Josh's challenge in the past year, I can tell you that it's a brew that you're not going to want to miss. So without further ado, thank you again, John, for your insight and your thoughts here. I do remind you as well that all the brewcasts are recorded and available for you to watch at your convenience on our YouTube channel. Simply Google YouTube E4 Insurance, The Brew. And if you would like to subscribe to weekly reminders for The Brew to show up for the live presentations, you can do so at our e4.insurance website. Again, John, thank you very much for your comments and your participation today. I'm your host, John Florence, and on behalf of all of us at E4, we appreciate you turning into this week's broadcast, and we'll see you next week on The Brew.